Sir, accounting standard 29 talks only about three things: provision, contingent liability, contingent assets. That's all. Okay, that's all is the scope of this particular standard. One, sir, executory contract you need to know. Because if it is executory contract, AS 29 does not apply. For executory contract, AS 29 will not apply. Okay, so that means we need to know what is executory contract. Sir, executory contract means those contract where neither party have performed their obligation. Neither party have performed their obligation, or both party have performed their obligation to equal extent. Like, to give you an example, let's say Reliance, no sir, Mr. X, no sir, has got a job offer from Reliance. Same example I used to give it in class. Okay, Mr. X has got a job offer from Reliance. So if he is joining, means he will get salary. Other than salary, Reliance is giving him 3 lakh rupees ka joining bonus. Just because he is joining the company, he is getting a joining bonus of 3 lakh. Sir, they made this contract, they made this agreement on 31st March 2025. Employment agreement is already signed, but the joining date is 1st May. Employee will join Reliance only on 1st May. This is executory contract. How? Sir, both the parties have not performed their obligation. What is Reliance's obligation? To pay joining bonus. Has Reliance paid this obligation on 31st March or not yet? Not yet. Why? Because employee has not joined. What is employee obligation? To join the company. Has that happened or not happened? Not happened. That means both parties have performed their obligation or not performed obligation. So if neither party have performed their obligation, we call such a contract as executory contract. That is one. Or both the parties have performed their obligation to equal extent. Reliance also has signed, employee has also signed. So both parties have performed their obligation only to equal extent. Such a contract we call it as executory contract. And if you have executory contract, AS 29 will not apply to such contracts. That is one. The next one is obligation. Sir, only if obligation is there, you'll think about recording provision or contingent liability. Only if obligation is there, either provision or contingent liability will come. If there is no obligation, no provision also, no contingent liability also. Sir, what is obligation? Sir, they have defined obligating event. Obligating event means where the company has no realistic alternative but to settle the obligation. Or in layman terms, I used to call in the classwork as no escape. If company cannot escape from this, then we call such scenario as obligation. Like, to give you an example, let's say A Limited has filed a legal case against B Limited because A feels B has stolen his patent. A Limited feels B Limited has stolen their patent. So A Limited has filed a legal case demanding a compensation of 40 lakh. Now, where is this case going on? In the court. Now, think from B Limited perspective. Can B Limited escape from this, or it has left his hands? Can B Limited escape from this? No. Who will decide this matter? No. Can B decide this or court? So that means this matter is in B Limited ka hands to be decided or court? Court ka. So that means B Limited has an obligation. If court says pay 40 lakhs, B Limited has to compulsorily pay 40 lakhs. Can B Limited escape from court ka order, whatever it is? No. That means here we say B Limited has an obligation. So that means B Limited basically has a no escape wala scenario. That no escape scenario only we call it as obligation. The moment obligation is there, then only you will think whether to recognize provision or disclose contingent liability. If obligation is not there, means no provision, no contingent liability. Okay. So there could be two types of obligation. One could be a legal obligation. Another one is constructive obligation. Legal obligation means those obligation which arise as part of contract or law. Like, companies have to pay gratuity to employees. This is payable as per Gratuity Act. Law says it. Any company can escape from it or they have to pay. They have to pay because this is arising as part of law. Such obligation we call it as legal obligation. Okay. Or it could be contractual obligation. Like, let's say A Limited sold goods to B Limited under a warranty. We sold one product and on that product 3 years ka warranty is given. Now the seller, can they escape from that warranty obligation or they have to fulfill it? Suppose if that product becomes defective, means can the seller escape or they have to repair that product? They have to repair or replace that product. Can they escape from it or can't escape? Can't escape because this is arising as part of a contract. So something which arises as part of law or as part of contract only, we call it as legal obligation. Another obligation could be constructive obligation. Constructive obligation means those obligation which arises as part of previous trade practices or customs. Something which arises as part of your trade practice or custom, we call it as constructive obligation. The same example I used to give it in class. Let's say Arivupro, we have a policy. What policy? Sir, any student who gets a rank gets 50,000 cash reward. Whichever student gets a rank, we pay them a cash reward of 50,000 rupees. We have not sent any email to students that we will pay you cash. We have not signed any contract with any student saying if you get a rank, we will pay you 50,000. But let's say, I forgot your name now. Siddharth. Sir, Siddharth checked with his seniors. Siddharth checked with the senior. He told, do this company really pay cash reward? I think no. So Siddharth senior told, yes, macha, actually they pay. Even I was surprised. I thought it was Goli. They actually pay. I got a rank and I also got 50,000 cash from Arivupro. Now you think, sir, one idea is set in your mind now, saying what? If I get a rank, I will also get 50,000. Did we make any contract with you saying I will pay you a reward of 50,000? No. But still that idea is already set in your mind. Why? Because of our previous practices. Because of our previous practices, one idea is set in your mind. An expectation is set in your mind. Yes or no? Such, there also we have an obligation, and such an obligation we call it as constructive obligation. Sir, for to account provision or contingent liability, obligation could either be legal or constructive. Okay, any obligation is there means we go ahead and do the accounting. Such may they're asking. Yeah, such may. Whatever you say. All right. Next one is, sir, I told you here, contingent liability provision are recognized only if obligation exists. Otherwise, both are not required. Sir, what is provision? Sir, provision is simply a liability. Provision is also a liability, but with uncertain timing and amount. Meaning, let's say here provision for warranty. This provision for warranty. You have already sold the product with a warranty period of 3 years. Now, can you say with certainty whether this obligation will come? No. How much it will come, can you say? When it will come, can you say with precision, or only you can estimate? You can only estimate. That's the reason we say provision is a liability, because if this warranty comes means the seller has to repair. Correct? No. So it is a liability, but with uncertain timing or amount. When this liability will arise, how much we need to settle this liability, you can't say with precision. You can only estimate. Hence the name. Okay, Saru? Alright. Sir, if you want to recognize provision, 4 criteria should be compulsorily satisfied. One is present obligation arising out of past event, which results in probable outflow of economic resources, and reliable estimate of the outflow can be made. If all these 4 are satisfied, then only you will recognize provision. Let's take this example. Same. A has filed a legal case against B Limited demanding a compensation 10 lakh rupees. Why? A Limited feels B Limited has stolen their patent. That's the reason A has filed a case. Okay. Now think from B Limited perspective. Can B Limited escape from this, or B Limited has obligation? B Limited has obligation. So whenever a case is going on in court of law, no, the best person to answer all this is what? Lawyer. So B Limited checked with their lawyer. What do you think? Lawyer told 70% chance, Goinda, Tirupati toss. We have to pay the money. And how much chance, sir? 70% chance. That means there is a 70% chance that B Limited has to pay. Correct? No? Alright. So now we'll go back to provision ka definition. What is first definition of provision? Present obligation. Does B Limited have an obligation? Yes. Arising out of past event. Now, why did A file a case against B? Because A feels B has stolen their patent. Has a stealing of a patent stolen already happened or yet to happen? Already happened. So past event is also there. Third is what, sir? Probable outflow of economic resources. Probable means more than 50% chance of the outflow. If there is outflow ka chance is more than 50%, we say it is probable. Here, what is the lawyer telling? 70% chance of the outflow. It is more than 50%. That means what sort of obligation it is? It is a probable obligation. And last one is reliable estimate of the outflow. Provision is also liability. How much you will pay, you should be able to reliably estimate. Lawyer will tell. Suppose lawyer told over here, I think we'll be able to settle for 8 lakh rupees. Or court will order us to pay how much? 8 lakh rupees. So that means lawyer is estimating that 8 lakh is a settlement value. That means you will not make provision for 10 lakh, you will make it for 8 lakh rupees. All the 4 conditions of provision, if it is satisfied, recognize provision. Otherwise, recognition is not necessary. Even if one fails, provision is not accounted like that. Okay, Saru? Alright, that's about provision. Next is contingent liability. Contingent liability means we used to say may or may not happen, blah, 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 blah. But actually there is a proper definition. Contingent liability means it's a possible obligation arising out of past. If you can remember a definition, because they may give you a case study. If you remember it, great. Otherwise, write it in your own words. So at your level, ideally you are expected to remember. So contingent liability means it's a possible obligation. Maybe I'll write it down for your reference. Possible obligation arising out of past event, same as provision. Instead of probable, it is here, it's possible obligation arising out of past event. The occurrence or the existence of this contingent liability is confirmed by happening or non-happening of an uncertain future event. Of an uncertain future event not within entity's control. Not within entity's control. This is the actual definition. Contingent liability means it's a possible obligation arising out of past event. The existence, whether you have this contingent liability or not, is confirmed by happening or non-happening of an uncertain future event not within entity's control. Fancy definition, but pretty straightforward. Sir, here, same thing. A has filed a case against B. B Limited check with lawyer. Lawyer told 20%, or let's say there is a 30% chance that we will lose the case. In the previous example, how much it was? 70%. Cut off this. Lawyer told there is only 30% chance that we will lose the case. Okay. Sir, if the chance of outflow is more than 50%, we call it as probable. However, if it is less than 50%, we call it as possible. For possible obligation, you disclose contingent liability. For probable obligation, account provision. That's all. Fancy definition, but meaning is same only. If the outflow ka chance is more than 50%, recognize provision. If outflow ka chance is less than 50% means 50% or lesser, then it is a possible obligation where you disclose only contingent liability. Contingent liability is not accounted. We don't pass any journal entry or ledger. You just show it in notes to accounts. Just a disclosure. That's all. Okay, now that is one. Okay, this is about the definition. Here, what it means is possible obligation arising out of past event. I think now you got to know possible obligation, meaning the chance is 50% or lesser. And this also should arise out of what event? Past event. Happening or non-happening of an uncertain future event. What does that mean is, sir, here whether B Limited has to pay A Limited or not, who will decide? Court, correct? So court ka, based on court ka judgment, B will pay. Whether B will pay or he will not pay is dependent on court ka verdict. Is court ka verdict within B ka control? No, that is country ka judicial system. Is it within anybody's control or nobody's control? Nobody's control. That's what they say, that uncertain future event, and that uncertain future event is not within entity ka control. That is what is the definition trying to say. Okay, sir. Or another way is probable obligation. Sir, probable obligation means contingent liability or provision? Probable obligation means provision, no. Probable obligation not recognized as provision. Probable obligation not recognized as provision because provision means 4 conditions should be satisfied. If condition number 3 and condition number 4, if it fails, then you can't account it as provision. You disclose it as contingent liability. What is third condition of provision, sir? Probable outflow of economic resources. Economic resources here refers to asset. Because if court tells B Limited pay, how will B Limited pay? He'll give some cash or he'll give some other assets. Yes, no. So that means B Limited, when they settle this obligation, asset will come in or asset will go out. That's what I mean by outflow of economic resources. The economic resource simply here means your cash or any other asset for that matter. Done now? Okay. Sir, same case. Lawyer told there is a 70% chance of losing the case. There is a 70% chance of losing the case. 70% chance means it is possible or probable. Probable. Lawyer told, we will lose the case. We will lose the case. But the court judge rather will say 0. No need to pay any amount. There is 70% chance that we will lose the case, but judge will say no need to pay any amount. We will lose the case, but still there will not be any outflow. Because the judge will say first time you have committed the offense, maafi for you. First time offense, maafi. So we will lose the case. That means it's a what, sir? It's a probable. But still, is there any outflow or no outflow? Sir, for you to account it as provision, there has to be an outflow. So if there is no outflow of economic resources, will you account it as provision? No. In this case, you will disclose it as contingent liability. That's what. Okay, sir. So that means this is what, sir? Third condition failing. What is fourth condition of provision? Reliable estimate of the outflow can be made. Sir, what if you cannot estimate? Sir, provision is recognized at best estimated amount. If you cannot estimate the amount means disclose it as contingent liability. So why can't we estimate, sir? Lawyer will tell no. Because sometimes what happens, sir? Like let's say I'm one company. I'm running one factory. I'm producing one product. Somebody has filed a case against me saying in 1995, I have contaminated a water body. We are in 2024. In 1995, somebody has, not in 1995, now somebody has filed a case. Why have they filed a case? Because 20 years back, they feel I have contaminated one land or river body. Now you tell me 20 years ka data I will maintain. So that means, can you tell me, can I reliably estimate the outflow? No, or little difficult? Little difficult. So in rare circumstance, in majority of the circumstance, outflow you can estimate. But in some cases, if the case goes on for many years back, it may be a little difficult to estimate. So if you're not able to estimate the outflow, means you cannot recognize provision. In that case also, you will disclose contingent liability. Understood? Contingent liability is not accounted, but it is only disclosed in notes to accounts. Yes, sir. Contingent asset is volta, sir. Till now, somebody else was filing a case against us. This time we decided we will only file the case against somebody. So that means in this example, till now we were analyzing from whose perspective? B Limited ka perspective. Now we are analyzing from A Limited ka. So from B Limited, if A has filed a legal case demanding compensation of 10 lakh, means for B it is an outflow, or B it may be an outflow. But for A, what it will be? An inflow. Yes or no? That means for A, you will record it as contingent asset, provided certain conditions are satisfied. Contingent asset means, or contingent asset means, it's a possible asset arising out of past event. Same, two definition of contingent liability only. Possible asset arising out of past event. The existence of this is confirmed by happening or non-happening of an uncertain future event, not within entity's control. Okay, so here you have written probable. Yeah. Actual definition, if you just check, they'll not use the word probable, they'll use the word possible. But what the standard says is, only if the inflow ka chance is more than 50%. Only if the inflow ka chance is more than 50%. Then only you can disclose contingent asset. Otherwise, you cannot show. That means, no, you tell me now more than 50% means it is possible or probable. For you to account or for you to disclose contingent asset, inflow should be probable. But definition uses the word possible because that is English definition. That is not percentage definition. It is a English definition. That's what they're trying to say. So that's the reason in my chart book, I've not written the word possible. I've written the word probable. But if you check actual definition, it is not probable. It is possible. Okay, sir. Got the meaning of possible here refers to not percentage. It is just the word English definition. Possible means you may get it or you may not get it. In that sense, they've used this particular word. But if you want to disclose contingent asset, inflow ka probability should be more than 50%. Meaning inflow should be probable. Only then you will disclose it as contingent asset. Same like contingent liability, contingent assets are not recognized but only disclosed. Yeah, sir, this PDF, yes, I told no, sir. Chart book, you can purchase it from learn.arivupro.com. I know that people will start asking. That's the reason first only I told you. You can visit our website, learn.arivupro.com or online.arivupro.com and buy this. It's available. It's called chart book. You can place the order from there. Or if you have purchased our regular classes, I do the revision video. After every chapter, I revise each chapter with the help of chart book. So you can use that. Your choice. Okay. If you want hard copy, buy it. Okay. So yeah, this is over. Next, recognition. So I have given you just a summary table from liability side, what you have to do, asset side, what you have to do. Sir, if it is virtually certain, we say virtually certain if it is more than 95% chance. If there's more than 95% chance, we call it as virtually certain. On the asset side, you book it as asset. On the liability side, book liability. If it is virtually certain, asset side book asset, liability side book liability. However, if it is probable, probable means what, sir? More than 50%. For more than 50% chance, on liability side, you will recognize provision. On the asset side, will you book it as an asset? No, it's a probable means you will disclose contingent asset. Okay. Next one, possible obligation. Possible obligation means 5 to 50%. We say less than 50%, but there is one more. So keep it as 5 to 50%. If it is possible obligation means, or if it is possible means on the liability side, you will disclose contingent liability. On the asset side, nothing. You don't have to disclose anything. Think that it is not there and move on. This is for 5 to 50%, meaning when the chance is possible. There is one more called remote. Remote means less than 5% chance. If there is less than 5% chance, liability side also you ignore, asset side also you ignore. You don't have to do anything. Okay, Nasaru? This is just summary on each liability and asset side, how you need to do, what you need to do. Next, two more small concepts, then we'll take up one question and we'll finish up this particular standard. Small ones. Next is onerous contract. I don't see any problems on onerous contract. I only see one liner, but still we'll stick. Anyway, in India is 37, any which way you have to learn in CA finally. Better learn now. I think I've taught it, not learn. We'll revise. Yeah. Let me use that word. Yeah. Onerous contract means loss-making contracts. Loss-making contract, we call it as onerous contracts. So if you have onerous contract, you still need to make a provision for it. Let's take a small example. So X Limited, Y Limited. X Limited, Y Limited have made an agreement saying X Limited will purchase 1 lakh units from Y Limited at 10 rupees per unit. 1 lakh units he'll purchase, and for each unit, how much he'll pay? 10 rupees. This agreement is made on today, but the goods ka delivery, sir, will happen on 1st May. We'll purchase the goods not now. We'll purchase the goods in future. But we have already made agreement. So why did you make that? Because in future, do you think price of the goods will be same or it will increase? If you expect that the price of the goods will increase, that means what you can do now? Now only make an agreement so that you don't have to pay increased amount later on. That's the reason they made an agreement. But agreement also says if the agreement by chance if X Limited backs out, if he cancels, then there is a penalty of how much? 80,000 rupees. If X Limited cancels the contract, he has to pay a penalty of 80,000 rupees. That's one. All right. Now this is an onerous contract. How? Or I'll give you one more component. On 1st March, sir, purchase will happen at a later date after 2 months. On 1st May. On 1st March, no, sir, our economy hit a recession. Our economy hit a recession. So we feel after purchasing, what do you think X Limited will do? They will sell it. Correct? That's their business, to buy these units and to sell these units. Let's say X Limited feels now they'll be able to sell these units only for 8 rupees per unit. Sir, they're purchasing at what price? 10 rupees per unit. They feel they'll be able to sell it only for 8 rupees per unit because of recession. I mean, you tell me now, this is an executory contract. Whichever way you go, it's a loss-making contract only. How? Sir, if you execute the contract, you'll buy it at 10 rupees. You'll sell it at how much rupees? 8 rupees. How much loss you'll make? 2 rupees on 1 unit. How many units? 1 lakh units. So total loss, how much you'll make? If you go ahead with the contract, you will make a loss of 2 lakhs. If you cancel the contract, you have to pay 80,000. So whether you go ahead with the contract or whether you cancel the contract, still you need to pay money. So whichever road you take, still it is loss and loss. Now you are a finance manager of this company. What you would like to do? You will go for a 2 lakh option or penalty option. That depends, sir. If we are in a bad mood, we will go for first option. If we are in a good mood, we will go for 80. Does it work like that? What does finance manager like to do? He will like to minimize the loss. Which option gives you the lowest loss? Exit penalty. That's what the standard also says. First of all, you got it that this is a loss-making contract. Such loss-making contract only we call it as what, sir? Onerous contract. For onerous contract, will we make provision? Yes. At what amount? Lower of the 2 amounts. Just like finance manager will choose lower loss option, standard also is saying lower of the 2 may you make provision. What are the lower of the 2? One is your exit penalty. Another one is, we say excess cost. Simply write it as excess cost. What is excess cost here? You will 2 lakh rupees. Yes, no? You will buy it for 10 lakh. You will sell it for 8 lakh. So cost is 10 lakh. Selling price is 8 lakh. What is the excess cost? 2 lakh rupees. So you will make the provision at these two come, whichever is lower. So in this case, you will make provision for how much value? 80,000 rupees. Okay, now people. So for onerous contract, you will make the provision in this particular amount. Can I go for next? Okay, next is reimbursement. So what is this reimbursement? Let's understand through a small example. So there is one company, P Limited. They are raw material manufacturers. Their job is to manufacture one material. That material, no sir, exclusively they will sell it to Q Limited. Nobody else. Entire material, whatever they have manufactured, they will sell it only to Q Limited. Q Limited will use this material and produce a finished goods. Like that. That's the business. So P Limited will manufacture one material that they will sell it to Q. That becomes raw material for Q Limited. Using that raw material, they'll produce finished goods. That finished goods, Q will sell it to their customers. This is the arrangement. Okay, sir. All right. Now, sir, one customer has filed a case against Q Limited saying your product is faulty. Let's say it's cosmetic product. He used this product and his face became so lovely, I tell you. Okay. So full red bubbles all over. One face cream they applied and full of bubbles. So he became so happy that he filed a legal case against you demanding compensation of 10 lakh. Okay. So now Q has to pay. Q checked with his lawyer. He told, Pakka Govinda, see his face. You don't have to even come to me. Okay. Looking at his face only, we'll say that we will Pakka lose the case. That means Q Limited has to recognize provision. That is okay. We are not talking about provision. there is another agreement between P and Q. What it says is, if Q Limited has to pay the customer something, 40% of that amount will be reimbursed by P Limited. If Q has to pay something to the customer means 40% of that P has to give it to Q. Why? Because P only supplied raw material. No? That means only Q is at fault here, or even P also. P also. That's the reason P and Q have agreed that if any settlement amount comes, Q will settle full amount to the customer, later recover 40% from P. Is that okay? So for this 10 lakh, we have to recognize provision. I'm not talking about this 10 lakh. Okay. What about this 40%? For Q Limited, this 40% is an outflow or an inflow? Inflow. Okay. So what AS 29 says is reimbursement should be recorded as a separate asset. Reimbursement should be recorded as separate asset, because from Q Limited perspective, this 40% outflow or inflow? Inflow. That means this reimbursement is a liability or an asset? Asset. So this reimbursement, Q Limited has to show it as separate asset, provided it is virtually certain. Virtually certain means more than 95% chance. If Q feels that there is more than 95% chance that he will receive this 40% from P, he will record it as separate asset. Sir, this is an asset. This is provision is what, sir? Provision is an asset or liability? Provision is an asset or liability? Liability. So Q Limited, no sir, is recording one provision also. He is recording one asset also. Provision is a liability. This asset and this liability should not be knocked off. It should not be set off. Provision should be shown separately in balance sheet. Reimbursement asset should be shown separately in balance sheet. Both should not be knocked off. That is what is the next point I've written here. Okay. Do not net off reimbursement from provision. Both has to be shown separately in balance sheet. Agreed? This is about reimbursement. Okay, G. All right. The last one is restructuring. Restructuring means closing down a division, selling a particular product, or closing down a particular product or division, closing down a particular geography. All that we call it as restructuring, or even change in the management structure. If you're firing some directors and bringing in new board of directors, that also we call it as restructuring. For restructuring also, you need to make a provision, but provided only for committed cost of restructuring, you make the provision. Only for committed cost of restructuring. Let me give you a small example, which is reality also. Initially, I didn't start CA coaching. I started CA practice. My practice did not click, so I came into CA coaching. Reality also. So I given my own example here. Okay, sir, I started my practice. To start a practice means obviously I can't do it alone. I would have had some employees also. Okay. Now my practice is not going good. Not going as per my expectation. That means those employees I will keep now, or I will say tata bye bye. I've decided to stop my practice means, will those employees I will keep it, or I will say tata bye bye? I will say tata bye bye. So can I say them tata bye bye empty handed, or I have to pay some money and then say tata bye bye? Usually when you fire an employee, you will not fire it just like that. You will pay some money and then say, okay, thanks for your efforts. See you in the next life or afterlife or whatever life. Correct? Yes, people, this is what is a normal thing. So whenever an employee gets fired, we don't send them khali haath. We also give some money. This we call it as termination benefits. Correct? So now let's say I need to pay, let's say I'm planning to pay 1 lakh rupees as termination benefits to those employees. Whichever employee I'm firing them, total payments I'm expecting to make how much? 1 lakh rupees. For this 1 lakh, you need to make a restructuring provision. So when will you make? So I called that employee and told, I'm closing down CA practice now. I'm planning to start CA coaching. Okay. Like this, I communicated to him. And I told that I'll give you some payment. I will give you some payment. Don't worry, I will not send you empty handed. I will give you some payment. Now you tell me, has constructive obligation already arisen for me? Because I called that employee and told, I will fire you. And I will not send you empty handed. I will give you some money. That means one expectation is already set. I have not made any agreement, but I've already set some, but he will get already some expectation in his mind saying what? I'll be fired, but I will also get some money. That means constructive obligation has already arisen. Okay, so you need to record the provision. So when this constructive obligation arises, or when this obligation arises, you need to recognize the provision. Done, sir? Usually we say that obligation arises when binding sale agreement is entered. Normally when you're planning to sell a division, you'll sell it to somebody, no? When you sell it to somebody, will you sell it just like that, or you'll make an agreement? So when the sale agreement, if it is entered, means automatically we say this is done and dusted. So you need to make the provision for it. Yes, sir? So,
if you enter in agreement, then it will be certain, virtually certain.
It will become virtually certain. Yes, correct. So I was saying, sir, if you enter an agreement, it will become virtually certain, no, sir. Then you have to record it. Yeah, agreement is virtually certain, but how much amount I will give is may not be. How much amount I will pay to my employee may not be. I'm thinking I'll pay 1 lakh. Later on, I looked at his face. Pop, I was feeling very sad. I said, okay, take 1,50,000. So that means this final amount could be more or could be less. Fine, huh? That is in that regard. Done up, people? Excuse me. And one more thing is, sir, what the word provision and liability are used interchangeably. The word liability and provision are used interchangeably. Study material uses that because provision is also a liability. Sir, what's the difference between creditor as a liability and provision, sir? Sir, if you have to pay the creditor 1 lakh means how much you need to pay? 1 lakh. I mean, is there any confusion there or total clarity? Total clarity. So that is your liability for you. Where obligation is very certain. How much you will pay, clearly defined. But in case of provision, how much you will pay, when you will pay, don't know. Not exactly sure. You can only estimate. That's it. But provision is also a liability. So don't come back to me saying, sir, instead of provision, study material is written recognize liability. Because they use the word provision and liability interchangeably. Is that fine with you? So that way you don't have to worry too much. Fine now? Alright, this one. So now coming back to this example. Sir, I'm moving from what to what? CA practice to CA coaching. Now I have an old laptop which I was using for CA practice. Now with old laptop, can I do CA coaching? Sir, if you want to do CA coaching, that to at online level, everything you need to have gaming laptops. Below that, the system will crash. The softwares are pretty high funda. That means it will not sustain. Like we are doing now 7 hours class and all. It will definitely not survive. The processor has to be i7. Minimum, we say i5. Ideally i7. The processor level. That means my old laptop, which I was using for CA practice, will it be sufficient for CA coaching or I have to buy new investments? New investments. Sir, can I make provision for new investments? No. If I'm planning to make some future investment in the form of laptop, iPad, mic, TV, AC, for that and all, I should not make provision because provision is relating to past event. The CA coaching is a past event or it's a future event? It's a future event. For future events, we don't recognize the provision. Okay. So only whatever is related to closure of CA practice, only for that I can make the provision. Whatever is coming related to this new CA coaching business, for that and all, don't recognize the provision. Suppose I am moving from Bengaluru to Bombay. Why I feel Bombay is much better, has a much better for CA, scope is better there. That means I have to relocate, means I'll incur some relocation expenditure. So can I make a provision for relocation expenditure now? No, because the relocation expenditure is related to CA practice or CA coaching. CA coaching, that means it is a past event or future event. So for relocation cost, for marketing cost, for future expenditures and all, no, do not recognize the provision because it is not related to past event but rather related to future event. All for future operating losses and all, we don't recognize the provision. That's what I've called out here. Yes, sir, Saru. Okay, now we'll take 1 or 2 questions and we'll wind up. Okay, come to question number 1. At the end of financial year 31st December 2017, company finds that there are 20 lawsuits. 20 cases are going on. So super company. Okay, that have not been settled till the date of approval of accounts. Sir, in respect of 5 cases, each case is or group of cases they've made. First case into 5, next 10, next 5 data they've given. They've grouped it into 3 categories. First 5 cases, sir, we have a 100% chance of winning. Sir, if you have a 100% chance of winning means, is there any outflow? No. That means should we have to recognize provision or disclose contingent liability or nothing? Nothing here. No outflow. That means no contingent liability, no provision. So come to the next 10 case. In the next 10 case, winning percentage is 60. That means what is the losing percentage? 40. Sir, now we are thinking from outflow side. Outflow side because we have not filed the case. Somebody has filed the case against us. When somebody has filed a case against us, is it contingent asset or provision or contingent liability? When somebody has filed a case against us, either we will record a provision or we will disclose contingent liability. For contingent liability and provision, we want outflow. Outflow arises with respect to chances of winning or losing. Losing. So we have 60% chance of winning means how much is the chance of losing? 40%. So there be an outflow only if we lose the case. No? There is 40% chance that we will lose the case means this is a probable or possible. This is possible. Agreed, sir? Correct. This obligation will become possible. For possible, we will record provision or we disclose contingent liability. We disclose contingent liability. Understood? Huh? So for this, we have to record contingent liability. That's what they are asking also. In fact, they only told how much contingent liability you will record. Sometimes they may not say whether you have to disclose contingent liability or record provision. So we need to figure it out. So in this case, definitely it is contingent liability. Agreed? Huh? Okay. Sir, there is a 60, they have given various probability for these cases. There is 60% chance that we will win the case. Sir, if we win the case means will there be any outflow? No. So 60% chance that we will win the case. If you win the case, no outflow. So 0. They will give you outflow ka amount, outflow ka probability percentage. Go on multiplying. That's all. There is a 30% chance that we will lose the case, and how much we will pay? 1,30,000. So take 30% into 1,20,000. Okay. And there is a 10% chance that we will lose the case and we'll pay how much? 2 lakh. So 2 lakh at 10% is how much? This amount. Sir, all this data is with respect to one case. All this data is with respect to one case. How many such cases we have? 10 cases. So ultimately, finally multiplied by 10. You will get the total. Total amount of what? Provision or contingent liability? Contingent liability, which is 5,60,000. This is with respect to 10 cases. That's all, or one more drama is there? One more is there. This is with respect to how many cases? 5 cases. What is the win percentage? 50%. Sir, if win percentage is 50% means lose percentage is also 50. So there will be an outflow only if you lose the case. There is a 50% chance that we will lose the case means outflow ka chance is probable or possible. Sir, probable means more than 50%. Probable means more than 50%. Here it's exactly 50%. That means obligation is what here? Probable or possible? Possible. For possible obligation, we record provision or contingent liability. Contingent liability. Okay now? Alright. Same. They have given you 3 different amount and probability percentage. So there is a 50% chance that we will win the case, and the outflow is how much, sir? 0. 50% into 0. Okay. Then there is a 30% chance that we will lose the case and we'll pay 1 lakh. So take 30% multiply by 1 lakh. Then there is 20% chance that we will lose the case and pay 2 lakh 10,000. Take 20% and multiply 2 lakh 10,000. All this data is with respect to how many cases? 1 case. How many such cases have we have? 5 cases. So multiply by 5. Total contingent liability will become 3 lakh 60. For this 560, for this 360, so total contingent liability is how much? 9 lakh 20,000. So you'll disclose a total contingent liability of 9 lakh 20,000 in your notes to accounts. Like this. Okay now? Next. Sir, company has not made provision for warranty in respect of certain goods, considering that the company can claim warranty cost from the original supplier. One company is there, they have to pay warranty amount. Okay, they're sure they'll pay the amount. That means they have to recognize what? Provision. Why have they not made? Because they feel they will get this amount back, or they will get this reimbursed from original supplier. So on one hand they will pay, on another hand they will recover. Okay, like here, X Limited, Y Limited, customer. Y Limited first will pay the customer, and later X Limited will pay Y Limited, or Y Limited will recover the money from X Limited. Okay, now think from Y Limited. If they pay 10 lakh means they will recover 10 lakh. That's what they're doing. On one hand, Y Limited will pay 10 lakh. On another hand, they will recover how much from X? 10 lakh. So that's the reason they're saying, on one hand I am paying, one hand they're receiving. No impact for me. I will not record anything. Correct? No. Sir, this 10 lakh payment you have to recognize provision. This 10 lakh receipt you have to recognize as reimbursement asset. Both has to be shown separately. It cannot be netted off. That is what you need to write away. Provision separately you need to record. Reimbursement also you need to record separately, provided it is virtually certain. That provision you need to write out or call out over here. Okay, G? Okay. One more question we will do for this. An engineering goods company provides sales warranty of 2 years to its customer. First we will sell and then we will tell 2 years warranty. So anything within happens within 2 years. If product becomes faulty, then we either have to repair or we have to replace. Based on the past experience, company has been following a policy for making provision and warranties on the invoice amount. So they only told we will recognize provision. Probably you need to guide the company how much provision you need to make. Okay. They make the provision for warranty on what, sir? On the basis of the remaining balance warranty period. They will check how much warranty period is still remaining at each year end. At every year end, they will check how much balance warranty period is remaining. And they are saying, if the warranty period remaining is less than 1 year, we will make 3% provision. If warranty period remaining is more than 1 year, we'll make 2% provision. This is the policy company has adopted. This is not 1 year, 2 years. What does this 1 year, more than 1 year, less than 1 year mean? Warranty period remaining. That's what they said. Okay. Now check the question. First, I think they've asked for 2 years here. Calculate the provision to be made for warranty under AS 29 as per 31st March 2012. This is your year 1. Also on 31st March 2013. This is your year 2. For both the years, you need to calculate. First, we'll calculate for 31st March 2012. So we have already sold the goods on 19 January 2011. How much is the value of the goods? 40,000. How much warranty are we giving? 2 years. So count to 2 years from this date, sir. How much it will be? 18th January 2030. Correct? Fine, sir. One day. Or if you want, you can write 19th January 2023 also. Or 2013 also. Fine. Now we are on which date? You are on 31st March 2012 now. First year ending date. Check, sir. Count from 31st March 2012, you count till 18th January 2013. I don't want the exact number. I just want to know whether it is more than 1 year or less than 1 year. From here to here, you count 31st March 2012 to 19 January 2013. How much period? So from 31st March 2012, if you count 1 year, it will be 31st March 2013. But this is only 18 January, no? That means this is what, sir? This 40,000 here is more than 1 year or less than 1 year? Less than 1 year. For less than 1 year, how much provision we make? 3%. So on this 40,000, we have to make provision at the rate of 3%. Agreed? Because that is company ka policy. If warranty period is less than 1 year, we make 3%. If it is more than 1 year, we make 2%. Now check. 29 January 2012, we have made a sale. Add 2 years to this. The expiry date, warranty expiry period is what? 28 January 2014. Now we are on 31st March 2012. Count from 31st March 2012 to 28 January 2014. Less than 1 year or obviously more than 1 year? From here to 31st March 2012 to 28 January 2014, if you count, obviously it is more than 1 year. So this 25,000 sale warranty period remaining is more than 1 year. So for 25,000 more than 1 year, how much provision we make? 2% provision. So first year we have to make a provision of 1,700. Like, okay, sir, this is I think MTB question or past paper question this is. Okay, sir, this is for first year. Now we have to do the same drama for next year. Next year is ending on 31st March 2013. Sir, this first sale ka warranty period has already expired on 18th January 2013. We are on 31st March 2013. So warranty period for this product has already expired. Now will I repair the product or replace the product or nothing? Warranty period is expired, so nothing we have to do. So for this 40,000, do I have to make any provision? Not required. So that's the reason, that's what they've written at the end. Okay, now. Alright, what about this 25,000? We are on 31st March 2013 now. Okay, warranty period is expiring on 28 January 2014. So count from here, you count till 28 January 2014. 31st March 2013 to 28 January 2014. Less than 1 year. Now this 25,000 warranty period remaining is less than 1 year. Less than 1 year, how much provision you make? 3%. Now next sale, 90,000 you made on 19th October 2012. Add 2 years to this. Warranty will expire on what day? 14th October 2014. Sir, you are on 31st March 2013. Count from here till here you count. 31st March 2013 to 14th October 2014. Obviously, it is more than 1 year. So on this 90,000, warranty period is remaining is more than 1 year. If it is more than 1 year, you make provision at 2%. So record this. Sir, why 90,000 was not considered previously? Sir, this 90,000 sale came in 15th October 2012. The first year ended on 31st March 2012. So was this 90,000 sale made in year 1 or it came only in year 2? It came in only in year 2. So hence 90,000 we did not consider for year. Understood? Huh? Okay. So first year you already made how much provision? First year you already made a provision of 1,700. What is the provision balance required for year 2? 2,550. This is provision ka closing balance. Okay. Sir, we need 2,550. Last year we have already booked what, sir? 1,700. Provision is a liability, right? Last year ka closing balance will become current year ka opening balance. So currently we already have 1,700. How much is needed? 2,550. So from 1,700 you need to increase the provision and bring it up to 2,550. How much you need to increase the provision by? 850. What is the journal entry to increase the provision? Any provision, the journal entry is P&L account debit to provision for respective provision. Here the provision is for warranty. So you'll write provision for warranty 850. That's what they asked. Okay, that is the requirement of the question. Provision ka closing balance you need to account, and also how much is debited to P&L. How much is debited to P&L in the second year? P&L got debited by 850. Okay, that's what they asked. All right, people. I think this is good enough for today. So we'll catch up, or we'll go ahead with the remaining topics in the tomorrow's session. So some more we'll do it in the tomorrow's session, same time. Tomorrow we start at 10 o'clock. So thank you for your wonderful patience and cooperation. See you tomorrow, same time. Take care. See you. Bye-bye.